What's up guys, in today's video I'm going to be talking about 5 reasons why we could potentially see a stock market crash during 2021. And whilst we have started to see the wood through the trees, the economic effects and the aftermath of the pandemic is certainly something that's yet to be realised. As long as the furlough scheme as well as stimulus checks are still in place over here in the UK as well as over in the US as well, you can largely expect that everything will be kept afloat. But where there is underlying concern for me personally is the minute that all of that money stops will be the moment in which we could potentially see a global economic collapse. Now, with an economic collapse on the table here, it probably wouldn't take all that long for risk off market sentiment and for investors to start pulling billions and billions, if not trillions of dollars out of the market on the whole. So let's talk about it in a little bit more detail. But before I do so, guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video, guys. It really helps out the channel. With that being said, let's dive straight into it. So despite 2020 seeing one of the worst and the quickest stock market crashes in history, we also saw one of the quickest stock market recoveries, with the S&P 500 closing out 2020 up 16.1%. Despite the economic calamities and the huge effects of the pandemic, the S&P 500 still had a way above average year. In fact, we were up about 7 or 8% above that of the historical averages, which certainly raises questions and concerns on how long can the stock market keep heading higher for, especially considering economic indicators aren't showing us all that much faith whatsoever. So let's dive into those 5 different reasons that a stock market crash could potentially occur during 2021. The first potential reason is the concerns around the virus variants that are currently spreading all around the world. Now, these new variants are spreading from Africa to the UK, right over the way to the US as well. And there's been lots of talk, especially in the English press, about how this potential new variant is spreading much more quickly and could potentially be more deadly too. But nonetheless, as always, when you're reading articles, I've also seen a lot of conflicting information as well. I've seen details that potentially the vaccine which we have now could potentially cover us for this new variant. However, in other cases, I've also read that the new variant could potentially be problematic for the vaccine. Now, by all means, I'm certainly not a scientist, so I thought I'd read you guys a small passage from a virologist who's a little bit concerned about this new variant. I think the evidence is building that these mutations and I think other mutations will emerge across the globe, and these new variants are escaping antibodies from the previous infection. Now, considering we're all still very much in lockdown over here in the UK, it would be extremely concerning to see that the new variant potentially couldn't be tackled by the vaccine in which we have. Simply the fear of the unknown could drive a hell of a lot of investors away from the stock market during 2021. It's almost like we saw back in March, where we saw the initial stock market crash. The drivers of the crash were largely based on fear because the pandemic was nowhere near its worst back in March 2020. And even then, the stock market crashed more than 30%. The second reason being furlough as well as stimulus both get cut. Now, if you're over here in the UK and you're out of work because of lockdown, you enter into something called the furlough scheme, whereby the government pay you out a set amount of money every single month as long as you're out of work. The same goes for over in the United States, but they get something called stimulus checks, but I'm probably going to just use those terms interchangeably. To put it into perspective in terms of how much all of this is costing, over here in the UK, we're talking tens of billions of pounds per month. And as you guys can see from this graph, the amount in which is being paid out by the UK government in furlough payments is growing every single month as well. And that's likely because more and more businesses are struggling, and because of that, more and more people are out of work. Now, over in the US, the story doesn't get much better because they've actually paid out to the tune of 2.6 trillion US dollars in stimulus checks from the latest reports in which I found. And the reality is it could probably be even higher than that. Now, when all of this finishes and fundamentally the money printers get switched off, this could have an extremely bad effect on businesses, which will not only adversely affect the stock market, but it'll also affect people's livelihoods too. Reason number 3 is that share buybacks continue to decline. And this kind of links into the point of the above, whereby if businesses are struggling, fundamentally they're not going to be setting aside millions if not billions of pounds per year in order to buy back the shares of their company at the market prices, which is pretty much essentially what share buybacks are. A company sets aside a set amount of money every single quarter or every single year to buy back a number of the shares in the company from the stock market in order to increase their own stock's value. As you guys can see from this chart, Q3 2020 share buybacks in the S&P 500 absolutely plummeted to just over $400 billion. That's down from nearly $800 billion as at Q1 2020, and fundamentally reverses the overall upward trend of share buybacks, and potentially now moving forwards, investors fundamentally can't no longer rely on these share buybacks taking place in order to inflate the company's stock price. Now, the reason why companies look to buy back their own shares is that it can help boost earnings per share, and obviously the higher the earnings per share, the more attractive that this looks to investors. So with fewer buybacks taking place, earnings growth could be notably slow, and with that, the likelihood of investors investing money money into these stocks could notably slow down too. Reason number 4 is that stocks are fundamentally very expensive at the minute. Look, I think this is probably fairly obvious to say, but stocks are certainly trading at a premium. A great chart to look at in order to put this all into perspective is the Shiller price to earnings ratio graph. Now, the Shiller PE is an inflationary adjusted price to earnings ratio, which gives us a fairly accurate comparison to the price to earnings ratio of that of previous decades. So as you guys can see, the Shiller price to earnings ratio of the S&P 500 currently is 34.92. That's higher than the stock market run just before the Great Depression of 1929 and much higher than the financial crisis of 2007-2008. The only real price to earnings ratio that we haven't yet got to on a historical basis is just prior to the dot-com bubble bursting back in the early 2000s, where the PE ratio was just under 45. Now, after which point the stock market went on to crash well over 40%. Now, as soon as investors kind of get to that same sentiment where they do now start to believe that stocks are very much overpriced, it would only take a few high-profile institutional investors to start pulling money out of the stock market in order to cash in the profits in which they've made, and for everybody else to simply follow suit out of fear and pessimism, which could fundamentally see the whole stock market come crashing down. Now, whilst this isn't necessarily a bad thing, because it's probably about time that the stock market actually reflected some fairer market prices, for me this is probably still one of the biggest concerns in which I have, because obviously speaking, I'm a long-term investor. I'm just cost averaging my way into the stock market, and because of that I'm continuing to buy into these stocks at kind of ever-growing prices. The 5th reason is that history fundamentally repeats itself. In the previous 8 bear markets prior to the March 2020 decline, there was an aggregate of 13 corrections ranging from between 10% and 19.9% in the 3 years following a bear market bottom. So in essence, what this is trying to say is in that the first 3 years after a market crash, so like the one that we saw back in March 2020, you can expect to see at least 1, if not 2, potential market corrections to the tune of 10 to 19.9%. So based on historical averages, we could certainly potentially see a stock market crash during 2021. But not only that, but we also see bear markets on average every 7 to 10 years. And before the bear market of March 2020, the last one in which we saw was back in the financial crisis of 2007-2008. So it took 13 years in total before we saw just one bear market. And driven by the severity of the pandemic, I wouldn't be all that surprised if we saw almost like a double dip stock market crash, whereby in 2 consecutive years we actually see 2 bear markets playing out as a result of the after effects of the pandemic. Now guys, they are 5 of many different factors which could obviously contribute to a potential stock market crash. But let me also just say this, these are all based on possibilities and probabilities, none of it's based on fact, and because of that everyone can look to speculate on when and how the next potential stock market crash could play out. When I consider all of the above factors and consider all of the possibilities at play here, at this stage of my investing career I'd probably welcome another stock market crash coming quite soon. The reason being that I'm obviously a long-term investor. I'd certainly welcome stock prices crashing and then investing in a hell of a lot more shares at a discounted rate. And to be honest guys, that's the mindset in which I'm going to take into any kind of uncertainties around the stock market, and that's always to have that long-term investor hat on. I'll never get feared out of the stock market, and I'll always continue to invest regardless of whether the stock market is going up or down. So with that said guys, do let me know your thoughts on a potential stock market crash during 2021. Do you guys think it's going to play out, or do you think 2021 is going to be another year of gains? With that said guys, if you did enjoy the video, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.